Hello, everyone, and thank you for attending our presentation regarding the investment analysis of sovereign self-storage. We are the Canisius College CFA Research Challenge team from Buffalo, New York. My name is Matthew Code, and I'm accompanied by Carl Larson, Stephen Miller, Kevin Monheim, and Ryan Zimmer. Now, Sovereign Self-Storage is a real estate investment trust that owns, acquires, and manages over 500 self-storage facilities. And as of April 2nd, Sovereign trades at $93.95 a share. This is 4% below their 52-week high.
Since its founding in 1982, Sovereign has been a continual innovator within the self-storage industry, recently focusing on third-generation self-storage. These facilities, as you see above, are multi-tiered, well-lit, and offer climate and humidity-controlled aspects. In addition, Sovereign utilizes a management platform that consists of their state-of-the-art revenue management system, the 24-hour call center, and web-based marketing program. Now, the revenue management system is key in that it prices each storage unit per facility. It takes into account 7 key pricing factors, including average occupancy rates, competitive landscape, and call center traffic.
As we can see from the map, Sovereign has strategically concentrated their properties along the eastern coast and in states along the southern border. Texas and Florida, which account for 40% out of total revenue, are attractive market due to the impressive population growth, low square foot per person, and the nature of the home foundations. The majority of Southern homes are built out of concrete slabs as opposed to basements. This limits home storage capacity and essentially drives demands in these areas. Recently, Sovereign has increased their presence in the Midwest, specifically in Missouri and Illinois, because of attractive market dynamics.
The self-storage industry is characterized by high switching costs, limited substitutes, and an intense competitive landscape. Recently, web-based marketing has redistributed bargaining power from suppliers to consumers as consumers are made more aware of pricing deals and occupancy in their areas. The industry is highly fragmented, with the 4 largest players, Sovereign, Extra Space, Cube, and Public Storage, controlling only 10% of the total market. This fragmentation presents an opportunity for Sovereign to capitalize on their economies of scale through consolidation. While there are few barriers to enter this market, it is both difficult and capitally intensive to replicate Sovereign's infrastructure and brand awareness.
Although the market is very fragmented, Sovereign has been able to differentiate themselves by focusing on supplemental revenue. The ancillary revenue segments provides customers with moving trucks, dollies, and packing supplies, and we've seen expansion in this segment. If we look at the competitive positioning chart, the top 4 self-storage players offers many of the same services. However, Sovereign is the only one with the 24-hour call center.
Strong economic tailwinds, including an aging population, an improving job market, limited supply, and a shift in demographics from homeownership to leasing have significantly benefited the self-storage industry. Friction within the job market and an aging baby boomer generation has led to increased movement within the U.S. As the elderly move south, where Sovereign has a strong presence, and as workers find confidence in looking for new jobs elsewhere, the demand for self-storage increases.
If we look at these 2 graphs, we've seen increased cost per acquired square foot and price per store due to a lower market supply. Sovereign operates in an upreit structure. This allows property owners to convert their ownership into umbrella partnership units in a REIT. In turn, this defers the seller's income tax liability, and this is an important factor, generating a more favorable pricing for Sovereign.
Sovereign's revenue and NOI are driven by occupancy rates, asking rates per square foot, and acquisition rates. NOI, net operating income, we define as total revenue less property expenses and SG&A. Sovereign has seen growth primarily in these numbers as a result of improving their occupancy rates. These rates have seen improvements due to limited industry supply, as well as Sovereign's aggressive internet marketing strategy. In addition, synergies from acquisitions are becoming accretive every year as a result of a continuing acquisition program. These additional properties, coupled with Sovereign's increased pricing power, have contributed and will continue to contribute to top-line growth.
Sovereign has increased their operating efficiency over the last few years, which has led to strengthening profit margins. While we have projected this forward, we have also taken into account that 2013 saw much less acquisition activity for Sovereign, which improved the bottom line with regard to CapEx. In addition, Sovereign has been able to maintain a relatively stable payout ratio while increasing their dividends per share, which we project to continue.
In terms of financing, Sovereign has a current capital structure of 55-45 equity to debt. Management has outlined a target financing structure of 70-30 for future CapEx, which, in turn, as you can see above, will lead to a decline in debt-to-assets ratio over time. This deleveraging of Sovereign's balance sheet will be vital to keeping their current BBB- bond rating.
To value Sovereign, we use three methods: a free cash flow to the firm model and two relative multiple valuations. In our DCF, we ran a 10,000 run Monte Carlo simulation using NOI as a proxy to free cash flow.
Now, in the long run, Sovereign will not experience the double-digit revenue growth that they did in 2013 and 14. This is mainly due to our belief that their average annual occupancy rates will be capped at 91%. Instead, future growth will come from improved pricing power due to macroeconomic tailwinds, a continued acquisition strategy, and management's dedication to expand their ancillary services. However, the combination of a cap on occupancy rates and a slowing acquisition growth rate, which will be due to higher real estate prices, will limit their long-term revenue growth to the mid-single digits.
In order to calculate a cost of equity and a cost of debt, we utilize the capital asset pricing model and a risk-free rate plus credit spread. In order to calculate WACC in a rising interest rate environment, we calculate into two tiers. In our first tier, we have a risk-free rate of 2.25%. Which is based on the weighted hike in the federal funds rate this year. In our second tier, we have a long-term sustainable risk-free rate of 3%.
Our calculation of the assumed cap rate, which is the expected one-year rate of return on an acquired property, was influenced by company guidance, historical trend analysis, and industry-specific research. We utilized the cap rate and discounting the terminal value in our DCF. We feel this is the best way to value Sovereign, given the cap rates drive the market value of each of their properties.
The Monte Carlo simulation was sensitive to five main factors, namely occupancy rates, asking rate per square foot, the net acquisition rate, the weighted average cost of capital, and the terminal cap rate. Now, the simulation accounted for variation in each of these factors, and after taking that into consideration, we are 87% confident that the intrinsic value of this company is between $80 and $108 per share. These price bands are based on a 15% margin of safety that we believe is warranted due to the stock price's recent volatility. And as you can see here, the simulation generated a mean intrinsic value of $94.84.
Moving on to our multiples build, as you can see, Sovereign currently trades light relative to its peers with regard to EV to EBITDA and priced FFO. In order to get an accurate relative valuation, we standardized our FFO calculation according to the NAREIT definition of funds from operations. Utilizing the average EV to EBITDA and price to FFO figures, we arrived at price targets of approximately $99 and $97 respectively.
Now, in summation, we arrived at a target price of $96, a 2% premium in relation to the current trading price, using a 50, 25, 25 weighting between our DCF, EV to EBITDA, and price per FFO multiple.
We have developed a matrix in an attempt to better understand and portray the probability, shown on the vertical axis, and the potential impact, shown on the horizontal axis, of the risks Sovereign faces. We took each of these risks into consideration when generating our Monte Carlo simulation. Sovereign's largest revenue-driving state, Texas, is currently seeing declines in operational oil rig counts as a result of falling oil prices over the last 9 months. With the potential for further declines in prices, oil companies have cut their forecasted capex, which has led to an uncertain job market. If oil prices do not recover, population density in Texas is likely to decline, which will lead to reductions in occupancy rates and pricing power for Sovereign.
When analyzing the corporate governance of Sovereign, we identified a major risk with regard to a lack of independence on the board of directors. The long-term tenures of 2 independent directors present a conflict of interest between management and shareholder alignment. While Sovereign has recently appointed 2 new independent directors in the month of January, a lack of independence still exists on the board today.
Sovereign currently holds a BBB- credit rating. A lowering of this credit rating would push Sovereign into junk bond status, forcing them to pay penalties on their privately placed notes and hinder their ability to finance future acquisitions. To mitigate this risk, the company needs to maintain a finance structure of 70-30 equity to debt basis.
Higher interest rates could adversely affect Sovereign in 3 ways. First, these rates would increase Sovereign's financing costs on their floating line of credit. Second, as shown via the negative correlation in the last year, a rise in interest rates would likely cause downward pressure on Sovereign's share price. Third, with regard to cap rates, there presently exists a higher spread between interest rates and cap rates than there has historically. For this reason, a sudden or dramatic rise in the risk-free rate would likely cause downward pressure on Sovereign's share price.
Sovereign operates in an industry that is benefiting from limited supply and macroeconomic tailwinds. And despite maturing occupancy rates and increased acquisition costs going forward, we believe that Sovereign will benefit from their management's ability to expand on their advanced technology platforms and invest opportunistically. However, we also believe that the market is adequately priced in the future growth prospects of the company